My name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center. Now, today I want to talk about all of the noise and all of the misinformation that is being shared about the passing of Trump's One Big Beautiful Bill. And this is coming from a lot of different outlets like YouTube. And people are saying some things that are completely false and have not been verified, like the elimination of Roth conversions and the mega backdoor Roth conversions for high income earners. And of course, as always, people are talking about how Social Security is going to be slashed and taken away. And we're going to dispel a lot of this misinformation that's out there because we pride ourselves on this channel of being a credible source to our viewers. And we want to make sure that we do that today. And we're going to break down certain aspects of this one big beautiful bill that is now passed and how it's going to affect your retirement income planning goals, how it's going to affect your taxes, and how it's going to affect Social Security. So let's go ahead and jump into this information today. Now, the first bit of fiction that I want to highlight is the elimination of backdoor Roth IRAs. Now, you may have seen other creators claiming that the backdoor Roth IRA is dead, but I'm here to tell you that is absolutely not true. There is no language in this final bill that specifies the elimination of Roth conversions. That means that if you were contributing to a traditional IRA or you were still trying to do the mega backdoor Roth IRAs from your 401k, you can still do that. So I do want to verify that if you are a high income earner and you're still using a non-deductible IRA to do Roth conversions, you are currently good as it stands today. Trusted financial forums have confirmed this part of your strategy that you're currently doing is still safe. The second bit of information that I want to share with you is absolutely a fact because the new deductions in the big beautiful bill could affect how your Social Security benefits are going to be taxed. So the bill added a new deduction for people earning overtime or tips. And so up to $12,500 per person can be deducted from your tips or your overtime. But how could this actually affect how your Social Security benefits are going to be taxed? And so we're going to break that down here. Now, if you're 65 or older, you already qualify for an extra standard deduction of $2,000 in 2025. So that makes your regular standard deduction as a single individual in 2025 $17,750. Now, if you are a married couple, it will make your standard deduction $34,700 in 2025 if you're 65 and older. Now, I want to break down how Trump's new bill is going to add some extra padding to your deductions. So, if you are a qualifying single taxpayer, that means you're 65 and older. The current standard deduction in 2025 is $15,750, plus the extra $2,000 age-based standard deduction that's already in place. Trump's big beautiful bill added an additional $6,000 bonus if you're 65 and older, so you can literally deduct as a single taxpayer, if you qualify, $23,750 from your tax bill. If you are a qualifying married couple, your normal standard deduction was $31,500 in 2025. And if each of you are 65 and older, you will have an additional $3,200 that you can add to your standard deduction. And you would get each $6,000 added to that standard deduction for a total of $12,000. And so you could deduct from your tax bill $46,700. So let's go ahead and take a look at a quick example of a single taxpayer, James. He's age 67 for 2025. Now, he's currently receiving Social Security benefits of $24,000. Now, let's just say James is actually earning a little extra income from tips of $18,000. Well, now he can actually deduct up to $12,500 from those tips due to the passing of this bill. And let's just say he's also contributing a little bit to his 401k of $2,000. So you can actually deduct that from your tax bill as well. So his adjusted gross income currently, as it would stand, would be $3,500. Now, when it comes to your Social Security income, you only add back 1/2 of your income from Social Security, which will, in this case, be $12,000. So his combined income would be $15,500. That's the $12,000 plus the $3,500 of adjusted gross income. With that being said, James' taxable Social Security income would be zero because he falls under the threshold for single filers of $25,000 before any of his Social Security benefits become taxable. Now, when you add in his standard deduction for being 65 and older, he'll also be able to deduct another $23,750 from his combined income. That literally makes his taxable income that he will file for the year to be zero. So, with that being the case, James would not owe any federal income taxes for 2025. Now, I want to examine another example of how this big, beautiful bill can affect you when it comes to your retirement income. Let's say we have Lisa. She's pre-retired, so she's not currently retired. She's age 63, and she's still working, but she's putting in some overtime. She's earning $55,000 a year working at the hospital, but she is getting also $10,000 of that in overtime. So that $55,000 includes $10,000 that she's earning in overtime pay. Her goal in this situation is to maximize her Roth conversions before hitting her required minimum distribution age of 75 without pushing herself into the 22% tax bracket. As we know, this new big beautiful bill has extended the tax brackets from the Jobs Act of 2017, so the tax brackets will remain exactly the same. So how can Lisa benefit from this? Well, let's just take a look at her gross wages of $55,000. Now, she can deduct $10,000 of her overtime pay. Remember, you can deduct up to $12,500. She had $10,000 in overtime, so she can deduct all of that overtime pay from her gross wages. And let's also assume that Lisa is contributing $6,000 to her 401k at the hospital or 403b. That will bring her adjusted gross income down to $39,000. Now, let's go ahead and add in her standard deduction. Now, she's under the age of 65, so she will have a regular standard deduction as a single tax filer of $15,750. Now, her taxable income becomes $23,250. So, what does this mean for her as it pertains to doing a Roth conversion? Well, she can remain in the 12% tax bracket and not be pushed up into the 22% tax bracket with income up to $48,475 in 2025. So she has up to approximately $25,225 that she can convert from a traditional IRA if she so desires without going into the 22% tax bracket. Now, with the overtime deduction and tax brackets remaining the same from the big beautiful bill, it gives Lisa much more room to continue to convert that traditional IRA into a Roth IRA by the time she gets to her required minimum distribution age. So the moral of this video is that you have to be careful where you get your information because there's a lot of misinformation that can be circulating when it comes to any passing of any new bill. But I will say that by combining these smart deductions and being able to do strategic Roth conversions, you can keep more of your Social Security benefits and pay less in taxes now. And of course, set yourself up for tax-free income later. That's how you can turn this big, beautiful bill into a big, beautiful retirement plan.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.